another episode of the Isn't That Rich podcast. Today, we are helping homeowners understand a hot topic called property taxes. And it's something a lot of us are dealing with right now because our property tax bills just came out. So lots of people are talking about it. And we have the pleasure of welcoming on our Williamson County Treasurer, Ashley Gott, to explain property taxes, why we have them, what they are. And I'm just excited. I'm excited to learn about it today because definitely a hot topic.
Ashley Gott has served as the Williamson County Treasurer since 2019 after being appointed to his role. He won a special election in 2020 and was reelected in 2022. Prior to his time in public office, Ashley spent 20 years in banking and twice served as chairman of the Marion Chamber of Commerce. He's been deeply involved with the community, serving 5 terms as a Marion Park District Commissioner. With his extensive experience in finance and civic leadership, Ashley is a trusted and respected figure in Williamson County. Welcome on, Ashley.
Thanks for having me.
Thanks for being here. I know this is a busy time for you.
Yeah.
It is. Yeah, to say the least. Yeah.
You're definitely probably getting a lot of questions right now, I'm sure.
A lot of questions, a lot of phone calls, a lot of people in person wanting to know, the information about their bills, why they went up, all the different aspects of the tax cycle and how your bill was figured and how did you come to that bottom dollar amount that has to be paid.
Yeah. Right. And that's why we're here today, because we want to kind of explain it in layman's terms so everybody can understand it. And as the bank, Farmers State Bank kind of plays a role in property taxes. We are an entity that can accept property taxes. So a lot of our customers come in and actually pay those taxes with us. So we figured we'd make it really clear to them. And this is great that we can sit down and explain how the process worked today.
Yeah.
Well, before we jump into property taxes, will you tell us what the role of a treasurer entails?
Sure. I mean, essentially the treasurer is the county's banker. I handle and oversee all the finances, all the investments. Depending upon the size of the county, sometimes the treasurer will only do that. I also handle all the accounting. So we do all the accounts payable. We do all the general ledgers, balance every account, which is about 80 plus accounts, and with anywhere from 10 to 15 banks in the county. We're blessed to have great relationships with all of our banks, including Farmers. And then we also act as the county collector. So we collect taxes on behalf of all the taxing bodies, which there's approximately 50 to 55 taxing bodies in Williamson County. And then we also administer and collect money for all the TIFs in the county as well, which is another probably 25 to 30. So in essence, about 80 plus, different entities that we collect on their behalf each year.
Wow, that's a lot. For those who don't know what a TIF is, can you just quickly explain it? Because I feel like that's something that's important and we're going to talk a little bit about it today.
TIF is tax increment financing. Each entity, mostly it's cities. You have to be home rule, to be able to adopt that. So you find your TIFs in City of Marion, Heron, Johnson City, Carterville, even Culp now, and Creel Springs. What it's designed for is it's a tool to help improve or attract developments that may be in a blighted area. So that it is there's a common misconception. They're like it's a tax, but yet it's not a tax that would increase your bill per se. An individual might have a TIF or, it showing up on their bill and that it may have, just for round terms, $500, in that amount. People think, oh, well, my bill went up $500, because I'm paying extra for the TIF. If the TIF wasn't there, that $500 would be redistributed within the other taxing bodies that are listed on your bill. So most of the time there's 5 or 6 other entities that are on the bill itself. So just in using round terms, that $500, $100 would have gone to each one of those, other entities. But it is a tax. So therefore, it is something that is figured, and it's money that goes to one of those entities that may not be able to go to another one of the taxing bodies, per se.
Gotcha. Thank you.
You're welcome.
All righty. Well, first section, we're going to understand property assessments and tax calculation. So can you walk us through how property values are actually assessed here in Williamson County?
I can speak to generalities. the assessments are actually done by the supervisor of assessments and the assessor's office, but the tax cycle itself is a 2-year process. It actually is a 3-prong approach. The assessor's office, the county clerk's office, and the treasurer's office all work in conjunction with one another in different stages in the process to be able to value those properties. Then we'll talk, I'm sure, about extensions and levies, and then the collection process, which is my main area there. But the assessor's office, values all the properties in the county. They will look at various things from market value to cost to income, of different properties, and then also the areas themselves. You may have an exact same type of building that may be worth more in Marion than it is in Heron, than it is in Carterville, than it is in Johnson City, just based off of the activity, the income that you might be able to produce on a rental basis. You may be able to get more in Marion than what you can in Heron, so therefore it's going to make it, more. They're not allowed to chase like sales per se. So if something's sold, you can't immediately increase the value. You have to go off of a 3-year rolling average from the state, which is provided by the Department of Revenue. So, taxes, again, I said it's a 2-year cycle. You're actually paying 23 taxes in 24. So the bills that I sent out this year are actually for 2023, payable 24. And that's what, the banks are collecting on our behalf. So all of that information is based off of the 2023 information, or the 3 year prior, which is that, which would be 2019, 2020, and 2021. So, those are things.
22. Yeah, we got you.
Yeah, a lot of different. A lot of numbers running around. So that's where they value those properties, and using that information from the state, as well as their own information and calculations, and then all other resources that they have. That's how you get the market value, but then it gets drilled down or decreased to the assessed value, which is actually 33 1/3% of the market value.
Oh,
so yeah. So it's like you look at your bill,
it's
and
lower than the market value.
Is. So using easy numbers, $300,000 market value is $100,000 assessed value, or $30,000, is now a $10,000 assessed value. That's how the EAV or equalized assessed values are calculated, within the county. And then that's also how the extensions and the rates and everything are figured, or based off of that EAV.
So it's not as if I sell my home this year and all of a sudden I got an appraisal on that sale and my taxes are going to skyrocket because it's over that 3-year term.
That's correct.
That's great.
Yeah.
Good to know.
However, you're either going to hear a lot of howevers or ifs or buts throughout this conversation. But if it happens, there's a thing called a quadrennial assessment, which happens every 4 years. Okay. And you are allowed to, within that 4-year period, every property is supposed to be assessed in the county. So the assessor can go out, and if the sale, like you just mentioned, happens, there's a possibility that if it was in that particular year, they would have the authority, to be able to say, yes, you went from $100,000 value and you just sold the house for $200,000. So we're going to just increase it,
bump it up,
per se.
Okay. They caught you.
There are limitations, like I said, and again, that's more so the assessor, area in that, but I mean, that's something, and that happens every 4 years. The next one's like 2026, I believe.
That was my next question. I'm like, when is that next one? We're hoping it's not this year, right? No.
No, there's been enough bad news this year, unfortunately.
Right.
Yeah.
So once you've set that value, or the assessor's office sets that value, how are the taxes collected, or calculated rather, and who decides the tax rate? Because we kind of talked about this before. We're like, well, does every state have the same property tax value, or tax rate rather? Yeah. And it's just not that way, is it?
No. 50 states, 50 different ways, and how you calculate it, 50 different ways, that you have funding for different entities, whether it be school districts or park districts or counties or municipalities. So the way Illinois is set up, which unfortunately, I think we talked about this, and you can look this up. Illinois is the second highest.
It is right behind New Jersey.
New Jersey, then Illinois.
Yeah. And even if you take that into consideration, I think we're even 50% higher than the national average.
Yes.
So a lot of the funding, has to come from property taxes. So the way things are done, and here is, like I said, that 2-year process. The assessment starts at the beginning. Then the taxing bodies, which I mentioned are about 50 plus, they all adopt a budget. Their budgets are adopted usually around their fiscal year end, which, depending upon what it is, a city or municipality may be around the end of April. The park districts or school districts, fire protection districts are probably June 30th. The county itself is actually November 30th. What they all do is they all adopt their budgets, and then there's certain things that you're allowed to ask for, and there's a thing called PTEL, which is the Property Tax Extension Limitation Law. And when you adopt your budgets, you're only allowed to increase those budgets by the CPI or 5%, whichever is less.
Okay, so the CPI is the Consumer Price Index.
Correct. Yes, and you go after the prior year, for that information. So on average, it's usually between 1% and 3%, and unfortunately, recently it's been upwards to 5%. So you've actually hit that 5% cap, and then you're allowed to include the growth, of the county as well. So every time you see a new building pop up or a new subdivision or anything else and all that new activity, that's considered to be growth. Or if there's something that fell off of a exemption that's now available to be used in that EAV category, those are all considered to be growth in the county. A TIF expires after 23 years or 35 years. That's considered to be new growth to all those other taxing bodies, because they never got that money prior to, that new year that it was coming in. Once you do all that, the entities also have an option to do what's called a truth in taxation hearing, which allows you to ask for more. The way the PTEL law is written is if you don't ask for what you're going to get, or even ask for a little bit more, you're not ever going to get it. So, I'll use the Park District, for example, since I'm on the Park District. The Park District holds a truth in taxation hearing. They ask for $1.4 million, knowing that after looking at the calculations, they can probably get $1.35 million. You ask for that $1.4 million, you send out a notice to, put in the newspaper to all the residents or constituents that live in those areas. You let them ask questions if they want, and go through all that process. You ask for the $1.4 million, then whenever the rates are calculated based off of the taxable EAV and then the budgets that were submitted, to the county clerk, then that allows you to maybe get $1.35 million or $1.37 million. It's still within that limitation amount, but you're asking for a little bit more. What happens with that stuff? If I start getting too deep in the weeds,
we'll stop you. Don't you worry.
I'm following. It's good.
Okay. So, if you only ask for 1.2 million that year and you were able to get the 1.3, you'll never ever see it again. So you're behind, the 8 ball per se, or you're behind the game whenever you're seeing those increases. So unfortunately, the way the law is written, the way PTEL is written, it's literally a force multiplier to increase your tax levies, every year, because if you don't ask for it, you will never see it again.
Can't turn around and get it.
Can't turn around. No look back provisions. And what you may not need today doesn't mean you don't need it, 3 years, 5 years, even 10 years down the road.
And so you explained this to me earlier. I think the easiest way to understand that is like, if you saw maybe more growth in our area, more people come into our area, we need another school. Mm-hmm. We need money to have another school. And so you're saying ask for that money now, because we can't go back and get it even if we need a school in 3 years.
Right.
That's really what that means.
So you're
it boils down to.
All of these taxing bodies are having to forecast, look into, a crystal ball, which nobody knows, of what will they need down the road. That example you just said, not only, even if you're able to get financing for the school itself, you still have staff you have to pay for. You have all kinds of equipment and supplies that you have to pay for. All of those things go into, those calculations or those assessments of what you're going to do in the future. So, growth does present, I mean, it's a good problem to have, but it does present a problem, for everybody. County is the same way. I mean, as the county grows, for example, the county's looking at building a new animal control facility. Well, that's going to be $1.5 million to $2 million project. If you don't live in Heron or Marion, I don't think there's any other like animal control units like in Johnson City or Carterville. So the county has to, supply that. As all those areas grow, the unincorporated areas grow, you need to have, staff, you need to have a facility to be able to handle, all of those things. So you have to look, down the road and in the future. And so if you don't ask for that money now, it's like, where are you going to get it? Or you're going to have to put on a referendum asking for people like, hey, will you let us increase your taxes? And nobody
no one's
ever going to say
yes for that.
No, never, ever.
Like, no.
Never, ever. No.
No. What happens if you don't use it all? So say 3 years down the road, you ask for all this money and you don't use it.
Well, I mean, it's government.
Yeah.
So
They're using it, aren't they?
government finds a way to use it.
Ashley.
We find, yeah. I mean, we find ways to use it. I mean, obviously you want to be conscious, of the, your area's needs or your taxing body's needs. So if, you're going to be dealing with obviously inflation, I mean, staffing increases, unfortunately, you find good employees. I'm sure you guys are aware of this. You need to try to keep them because the employment pool is not large enough to be able to, so you want to keep those people. Obviously wear and tear, infrastructure, that all costs money. You got decaying water lines and roads and everything else that need to be addressed. Facilities that may, have lived beyond their useful life.
Right.
You can only remodel and improve things so much, and then they just, are obsolete. Perfect example, like I said, is our animal control facility. It's a small little, area that's been added on to and has outbuildings and all that. I mean, to try to create an actually workable and usable facility, to be able to do that. So you should have a plan of what you're wanting to use it for. You don't just need to hoard it.
Right.
But everybody needs reserves. I mean, that's the other thing too, is state doesn't give you money, or some catastrophe happens, a May 8th storm back in, the mid 2000s, that type of thing. Those are things that have to be taken care of, and you have to make sure you have money on hand, to be able to do it. So you just hope that whomever you put in office, whether it be a county commissioner or a park board commissioner or a school board member, that they're, using the funds wisely, when they're adopting it, and whoever that CEO is or superintendent, that they're making sure that things are used in the proper manner and it's not just, used on frivolous things.
Right.
But you can always ask questions. I mean, all of us as constituents and taxpayers and property owners, I mean, you're welcome to ask, and go to all of the school board meetings and park district meetings and county board meetings and everything that you want to ask questions and make sure that the money is being used wisely.
Yeah. And I think you should.
And I think that's so funny that people, we're almost upon a huge election, right? And people are more concerned about the presidential election than actually going to these things that are directly impacting. Yeah, our local government is so important. So get involved in that. Go to the school. Like you said, go to these meetings and make your voice heard there.
Well, I even think when you're talking about voting for something about like, can we raise your taxes? Like, people are obviously going to want to say no, but it's educating people about why we have property taxes and why you do things that you do. Right. I've learned a lot already today. You mentioned the word levy. Can you kind of talk about that more for people? We don't know what that means. I mean,
really. levy is it's kind of a synonymous term with budgeting or a budget. Okay. So the taxing body or the entity adopts their budget, which then becomes their levy or the amount that they're asking for, for the for their extension or for me to collect on their behalf, and then the part about the PTEL limitation goes into effect. So in essence, again, the levy is based off of the budgeted request. Like you have to turn that into the county clerk on the last Tuesday of December every year. Okay. So even if you adopt I'll start, different terms, but even if for the park district, for example, even if we adopted a budget in July, I mean, we usually try to turn it in as soon as we can, but you have
before that Tuesday.
Yeah, but you have until that Tuesday of December. So you can make modifications or you can make changes, to it, or you can reopen the budget and do a new proposed, budget to be able to, have that, changed if, your needs change in that 6-month time frame. Then after that levy comes in, that's whenever the taxes are extended based off of that EAV or the taxable EAV. And when I mentioned that, so the county as a whole has approximately $1.6 billion in EAV or equalized assessed value, which is significant compared to all the other counties around. But you have to start to take out all of the exemptions whenever you look at what the taxable EAV is. So that means you're taking out all of your owner-occupied exemptions, your over 65 exemptions, your senior freeze income exemptions. There's a home improvement exemption, disabled homeowners exemption. I'm trying to think of what else in the assessor's office. There's veterans, disabled veterans exemptions that are all in there. And then also any TIF. All of that gets carved off of that top. So that 1.6 gets dropped down to about 1,353 million. So whenever you're calculating the rate and you're using that levy number, you're working off of that number.
Not the lower number.
The lower number, not the 1.6.
After all the exemptions.
Yes. Yeah. And that's by law. Everyone's allowed, if you're, eligible for those. I mean, you're allowed to sign up for all of those.
I love talking about the exemptions because I didn't realize that until this year that Tom and I would have probably qualified for one of these exemptions. We just didn't know how to go about doing that. Can maybe you explain what exemptions are, how you apply for those exemptions, and how do you approach that?
Yeah. Again, I'll kind of speak in general terms because that's actually in the assessor's office.
Right.
All the exemptions are applied, by the assessor, whenever they value the property. Those exemptions you sign up for. And
you don't automatically get them.
You don't automatically qualify for any of them. There is, if you buy a house that already has one, it can be transferred, but you still have to sign up for it.
Right.
So if you're using a realtor or whomever, make sure when you look at your tax bill, you try to familiarize yourself. On the left-hand side of our bills, it shows all of the exemptions that are available. So it will show owner-occupied. It'll show homestead, which is the over 65. It'll reference, the disabled veterans or the senior freeze or, or the home improvement exemption. All of those are there. If you don't see a number assigned in that box, then you don't have the exemption.
Right.
And I mean, it's significant. So just for example, owner occupied, if you lived in the property,
one that we,
this is your primary residence, that's a $6,000 exemption off of the assessed value.
Wow.
Average rate currently for Williamson County, we'll say is around 7%. Well, 6,000 times 7%, that's $420. So if you just sign up for that and you get that exemption, that's $420 that comes off of that tax bill.
Which
is, I mean,
I'll take it.
Yeah, everybody will take it, even if it's a small amount. So, I mean, others are different. The over 65 is 5,000, but the same premise applies. It's 5,000 times that 7%. That's another $350.
Yeah.
So now all of a sudden we're adding those together. We're almost up to $1,000. And, I mean, on average, the average tax bill can be anywhere from, $1,500 to $15,000. So, I mean, every dollar matters no matter what price your bill is.
Right.
Will you explain the 7% again? Where did you get that number? What is?
Okay, so that's the rate. That's the calculation of the tax rate, which is what I do on my side. That's taking every single entity that's on your tax bill. You add those rates together, and that becomes your cumulative rate, on your tax bill.
Okay.
So in essence, if there's 6, the school district could be 4.5% of that portion. Then the county could be 1%. So we're at 5.5% of that. Then the park district could be 0.5% of that. And the city could be, 1% of that. And you start adding all those together, and then that's where you come up with that 7%. So it's not, I say 7% because it's around, but it's a number plus like 5 decimals, that's there because you're adding all of those together. I mean,
times pi.
Yeah.
It's starting to click with my brain about how, okay, so I'm getting it, Ashley. I might work in your office one day.
Ashley,
I'm always looking for help, especially temporary during the tax collecting season.
I was reading my property tax bill to these two yesterday, and you could have thought I was speaking gibberish. Jared was like, oh, got it. Yeah, that makes so much sense.
Like, so just like, and this taxing
EAV
body
homestead anyway. It was you have a tough job is what I'm saying.
It is. I mean, even if you've lived it, I mean, like I
Yeah.
said, I was on the, being a commissioner, park district commissioner, and knowing the budgeting and the levying side, and then obviously receiving the money, and then now being on this side of collecting it and calculating it, there are still nuances that even I don't remember, or I still have to, re-educate myself or reintroduce myself to that, just because there are all these exceptions,
Right.
or one-off, issues that you have to take into consideration, whenever things are being figured. Again, you have, TIF districts and enterprise zones, and now we have a star bond, district that's starting to be developed. Those are all things that are unique maybe to that particular bill. Star bonds is unique to this particular county.
Right.
So, this is something that is a totally unfamiliar, area that we're going to have to look at and make sure that we're doing it properly and trying to get advice and guidance from, another state that has these in effect, but yet their state tax codes and laws are
Completely
not the same
different.
as what ours are. So,
Yeah.
So I mean, it's ever changing. You have to stay on top of it. And again, even living it day in and day out, it's still hard to keep up with or to fully comprehend sometimes.
Right. So I know this is probably a question a lot of people has, is, taxes typically increase slightly year over year. Are there any caps on how much your property taxes can increase? Or that would be an assessor's office question.
Well, it's the PTEL thing.
PTEL.
Technically, it's not, you're not allowed to go over that limitation amount. So for example, like my office, last year, I'll just round it off, I collected $106 million on behalf of all the taxing bodies in the county. This year, I'm going to be collecting $114 million on behalf of all the taxing bodies, and entities in the county. That's roughly a 7.8% increase. That's the maximum allowable amount to be increased overall, based off of that PTEL, that 5% plus a growth rate of around 2.7, 2.8%.
Okay.
So that's where it caps it. This year is a different story because they redistributed the values or the assessed values this year in different townships. My bill itself went up 22%. Other people, their bill went down 17%.
What?
Yeah. This is a unique year, never happened before. So unfortunately it is what it is. But, the overall collection though, in my office, again, only went up that 7.8%.
Okay.
Not to get too deep in the weeds on this part, because I could probably talk about this for hours, but in essence, you got to just picture a big pie, and it all, and each household or each bill is a unit. If you take that unit and start to divide it up, the pie's, divvied up, in sections, and each one, that's your respective section to pay. What happened was some properties, their pie or their piece of the pie widened or got larger while others shrunk. You still have the same pie. The pie wasn't made bigger,
Right.
but yet my portion is higher now than maybe what your portion is or what your portion is. So, and it varied on percentages, where mine maybe went up 22% and another person's went down, 15 or 18%. Another one only went down 1%. And the other person's maybe, went up 15% or 16% or 12%. So the pie stays the same. It's just the distribution, or the collection of those, differs.
Okay.
Got it.
So like yours went up 22%. Are you talking about like your house, right?
Yeah.
So
well,
it
my
went up,
bill itself went up 22%.
Your bill.
Yes.
Because of the assessor takes all of these things into consideration, like market value, like all the things you talked at the beginning.
Yes. So my area or mine was increased, or my assessed value went up approximately 16.5%. Then there's a bunch of little other factors in there with collection of where do you live, the TIF. When I talked about all those exemptions, when you're taking out that 300 and plus $1 million out of that taxable portion, that means that if I'm not in a TIF, I got to pay for that difference.
Okay.
If you are in a TIF, all your increase went into the TIF. So for example, we had a particular TIF that collected around $870,000 last year. This year, because of all the increases of assessed value, that same TIF is going to collect $1.7 million. So all of the increase went into the TIF. All the other parts of a TIF bill are frozen, essentially. So that meant that I had to pay for that extra, frozen portion, that was there. So that's why I said 16% technically, but then actual, cost 22% or 15% or 18%, because you have to pay for those extra portions depending upon where you live, if there are TIFs, if there are not TIFs, if there's other, or maybe one town has a aging population. So they had the most over 65 exemptions that are available. That all, gets, carved off of the top, and you can't tax that. So there's, like I said, the number of factors that you could jot down,
is endless.
Is endless.
Yeah.
So there's so many combinations, of that you could put together and still not arrive with the same, results, because of, you just don't know how the makeup of, that taxing body, unit area is.
Yeah. Wow. There's so much to it. I want to talk about your job and more of like the timeline of the bills and how that kind of works. Can you go through that process?
Sure.
When the property tax bills usually come out, that kind of thing?
Yeah. So there's actually a statute that states there's actual set dates in which the taxes are supposed to come out. In essence, they're supposed to be mailed out like the first part of May, and then you can actually read, if you want to go to sleep, you can read the.
Maybe I'll attach it in the show notes. I don't know.
the tax statutes, for Illinois, and June 1st is technically the first due date, and September 1st is the second due date. That usually doesn't happen in most counties. In essence, what you're supposed to do is whenever you send them out, and by law, I'm just supposed to make a good faith estimate and attempt to send them out, because people maybe move or they change lenders or whatever else, and they're just mailed to whatever address we have on file. I have to give 30 days from the date that I send them out to the first due date. And then you have to give 30 days in between the first due date and the second due date. Those are the minimum limitations. Now, in a perfect scenario, it'd be great to send the bills out, say in May, not make them due until, July, give someone 60 days to be able to make, their payment, and then span it out another 60 or 90 days afterwards. The problem with that is, one, you got to be cognizant of a lot of these taxing bodies or the entities that are getting this money. They rely on that to operate. So you can't just span it out, forever. So that's where you got to kind of, work off of that. But in most cases, prior to some issues that we've had, they used to be sent out in the end of May, first part of June, then had due dates in July and then in September. So you usually had 60 days in between the second one. And if you don't make your payments, you're, allowed or required to charge interest on those. So you're allowed to charge 1.5%, of the outstanding installment, per month until it's paid, is how that works. But that's the prime thing is, yes, you always have to have 30 days in between sending them out, collection of the first installment, collection of the second installment, and you have to ask for 2 equal payments. So if your bill's $2,000, first installment payment's $1,000, second installment payment is $1,000. You can't vary that in any way, shape, or form.
Question for you, because I was confused by this. So there's 2 installments, and if you don't pay the first one on time, but you pay the second one fully, is there any repercussions for that?
Yes.
Yeah.
So the due dates are not a suggestion. A lot of people think that they are. They also have a lot. There's a common misconception. I get people that come in all the time. Well, I paid the bill in full by that second due date. The due dates are there, and because I'm required by law to distribute the money to the taxing bodies within 30 days of receipt. So I've got to set those dates and the payment times in which I take that money in and then disperse it out. So if you fail to make that first installment payment, then there's a 1.5% interest that's paid. There's no discount
for
to
paying
pay early, unfortunately.
Paying the whole thing early.
Only Florida. Florida's the only state I found that offers a rebate.
You're kidding me. They do?
Yeah, it's
Dang
weird.
It, Florida. Let's go. No,
that's why everyone moves there.
Yeah, exactly. But yeah, so that's, you are required to pay them by those due dates, because I have a set schedule in which I set those dates. I disperse the funds. I'm also required that if you don't make those, first or second payments, I have to send out certified delinquent notices. I mean, literal certified mail with the tab and the barcode and everything else that has to go to everyone to tell them, hey, you didn't pay your payment. And then after that happens, if they don't pay their payment, then I'm required by law to sell them at a particular time at a tax sale,
And
to sell them to recoup that money, for the taxing bodies. That's how that works.
And I'm excited to talk about that auction just a little bit
We can do
because
that.
I have
Yes.
no idea. I didn't realize there was such a thing, and it's held every January apparently in Williamson County from my research.
It can vary. It's been in November. It's there are actually, when we talk about this, there are actually two separate auctions, and we can go into that more in detail.
Well, I was going to ask you this question about if someone is going through a tough time financially, are there payment plans? But I guess there's not. You just have to.
Unfortunately, when they're due, they're due.
You got the 2 installments.
You do. We do offer a prepayment program. So once we finish the tax cycle, people are allowed to come in and prepay their taxes. We try. I have a Facebook page and everything else. We always try to tell people, maybe when you're getting if you're getting a tax refund, that perhaps maybe you should use some of that money and go ahead and prepay your taxes, if you have, the funds available. If you happen to come into, if you get a bonus or you work overtime or whatever else, if you have extra money, that you can always apply that, and you can apply up to 100% of the prior year bill. And then whenever we start to prepare the bills, we actually apply that money, towards those payments. Sometimes it may pay the bill in full. Sometimes it may pay the first installment. It may pay the first installment, a portion, of the second installment. But then, that's all you have to do is just pay the difference that's due. And we have a lot of people do that, but it's, when you're talking percentage wise, when I send out 53,000 bills, it's less than probably 1% that actually take advantage of that. Yeah.
So tell me this, if I got let's just use easy numbers. Let's say I got $1,000 bonus and I was like, here you go, Ashley, I want to pay my taxes.
Yep.
But my taxes were only $500. Are you going to give me the other $500?
Yes.
Okay.
Yeah. I have to send, so I have to, when we finish our cycle, we're required, we send out letters to everybody for overpayment. Overpayments, yes. And they are allowed, whether it have been, like you mentioned, that maybe something you tore down a building or something, and so your bill went down. You found an exemption that your bill went down, and you're able to reduce that. Anything that's if there's an overpayment, we send notification to you, and then you just fill out a refund form, and we give you that money back. There's I'm required by law to hold the money for 5 years. So if any time within that 5-year period you find or you pulled your letter that I sent you out that you had stuffed in a drawer 2 years later, and you're like, oh, I have this, you can still come in and get it and get the money. And then you can I can give you a check and refund you the money. Some people, they have escrow, they want the money put back, or applied to their escrow, they'll get the money, or we'll have they'll have the lender ask for it to be sent in, so they'll apply it and put it in their escrow account for their analysis. Or they can ask for it to be applied to the next year's bill and create a prepayment in that way.
That's a good thing about escrows. Setting back your money every month and putting in your payment so that you don't just decide to spend it every month and then Ashley Gott's coming after you.
Well, unfortunately, yeah.
So I'm ready to get into the auction part.
Okay.
So people have not paid their tax bill. After what point does this auction start happening?
So, for this particular year, it's happening January 23rd. So
for the year 2023, you don't pay your property taxes throughout the year 2024. In January is when the auction, the house or the property would go up for auction.
Right. Sometimes it happens anywhere between November and January. You're allowed to set it, at whatever your tax cycle is. And then we hold, it's a live auction. They're actually tax buyers.
This is what I was reading about is that there are people that literally invest this way. They go buy people's unpaid taxes and then hope that they can buy their property. Yeah.
Well, either they take their house or you bid a percentage, and then so you earn money on the interest that you bought. Now, so it is a business. Those people that do it, that is some of their livelihoods. It's allowable by law, to do so, but they register, and then we have a live auction that, the tax, the unpaid tax amount pops up on a screen. They bid anywhere from 0 to 9%. 9's the maximum. But if it's a desirable property, the more desirable the property is, the lower the the bid is. But then that happens. You bid on it. Whatever they buy that day, they write me a check for it. So, I mean, I have checks that are several $100,000 that are written to me, by these tax buyers buying up, hundreds of properties, that they purchased that day. And then there's a process that there are legal requirements in which they have to send notifications. And I mean, it is a business. I mean, you have to be well-versed and understand this. People that think they're going to buy their neighbor's property and show up, you can lose money. I mean, there's no guaranteed way to get this. And if you don't follow the proper path of the notifications and doing the, you can pay the taxes the following year and then the next year to be able to get that property, as you mentioned. It's a 2.5-year process. Actually, it was, here comes one of those ifs, or however. They just passed a law recently that allows for commercial properties or vacant properties to be accelerated per se after 1 year. They can go for a tax deed immediately. But you have to go through, again, you're sending all these notifications, you go for a tax deed, you have to go for a judge and get an order. There's, even with that, order that you get a 6-month, window before it actually goes to that company, and you can always pay it in full. I don't handle any of the delinquent side. I only handle current. The county clerk actually handles all the delinquent taxes. So there's a little delinquent tax window across, the lobby from me. And many times we have to send people over because they haven't paid, that prior year tax, but those have to be paid in full, with all the interest and all the penalties and everything that's been applied, to those. And then it could be 1 year's worth of taxes. It could be 2, it could be 3 years worth that they may have to redeem, and they got to have certified funds to do so. You can't walk in here and write me a personal check. It's got to be a certified cashier check. It's got to be a cashier's check, a money order, or cash. I mean, that's the only way that those can be paid, because they have to be guaranteed that thing is going to clear in order to be able to stop the process. But
oh my gosh.
Now there is another auction, which, and it's called the surplus auction. That one happens usually in October and November of every year. That one we have a trustee program, which in essence is the taxes that aren't bought. Not every property is desirable. It may be a small piece of property. It could be landlocked. It may be something that, has some kind of issue that nobody wants to bid on. That goes into our trustee program. Same premise applies. It's still that 2.5-year period. But once it goes in the trustee program, then it becomes the property, in essence, of the trustee or of Williamson County. Then we have that auction where it's a sealed bid auction, and you, me, anybody can make a bid on that. And if they win the bid, they automatically get the property. Wow. So, if there's a piece of strip of land that's next to your house that you're like, oh, I'd like to have that. Nobody wanted to buy it because it was in between two and you couldn't build anything on it. That property may show up on that surplus auction. Okay. And then you can bid, like the minimum bid's $850 or $810. But, we have people that bid $3,000, $6,000, $10,000, $20,000 for a property because that's what they want it. And so if they're the winning bid, then they immediately
own the property, get that deed.
Without going through that process.
Do they have to, pay the back taxes on those properties in the surplus auction?
Well,
or you're just paying, it's in the surplus, now you're just bidding on it.
Yeah, there's no taxes due. I mean, in essence, it goes in the trustee program, and then it's technically, it's never been on the tax rolls per se. It's not. It was, but then when the trustee program happens, it just goes through the legal requirements, but no money, exchanges hands, and then that bid, it becomes, when it becomes property of either the trustee program or of the county, there's no taxes on it. So when you make your bid, that $3,000 is what you're bidding, and then the following year when it becomes your property, then it goes back on the tax rolls.
You start paying taxes on it again.
Yeah. So in essence, for the county, it's a mechanism to get non-paying properties back onto the tax roll, as an actually income producing property for all the taxing bodies that are involved with that particular piece.
Crazy. I feel like that could be a whole episode. The whole property auction.
Yeah,
It's
yeah.
very
and
interesting.
It's growing by popularity.
Yeah.
Because people don't understand the tax sale part. They don't want to go through all the steps, that are required and the legal steps. But this one is, I've got the money. I bid on it. I win it. They sign a deed over, and it becomes their property.
Yeah. So interesting.
So tell me this: if someone has a mortgage still, I do scenarios. I have a mortgage and I pay property taxes like everybody else, and then I didn't pay my property taxes to you, Ashley. And so then Jill goes to the auction in January, and she's like, "I really want Ashley's house." She pays my back taxes. Now that she's paid my back taxes, does she have to pay my mortgage?
No.
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 I'm fired up.
No. Yeah. So
that's why this is such a hot business, because people.
It is. Yeah. You're not required. And
Wow.
those, when I talk about the legal requirements, those notices, they're called what's called a take notice. Like I've taken, I've taken possession of the taxes, or I'm now the owner of those taxes that puts them on notice. That's supposed to go to all entities that have a lien on that property. So it goes to you. It should go to your mortgage company and anybody else that, if there's if there's some kind of UCC or something that's filed that's attached to the property itself. All those organizations are noticed up. So hopefully your bank sees that, they call you and say, "Hey, you didn't pay your taxes," or they say, "We paid your taxes on your behalf." They've either added it to your loan or they're going to increase your escrow to be able to catch up and pay that. But that's one reason why I said there are legal requirements. And if you don't do those proper legal requirements and the notifications as that tax buyer, you're not allowed to jump in there and do an "I got you" moment and say, here you go. Yeah. So, and the other part too is not to start to dive on a tangent, but Jill can't pay your taxes and for the next 3 years and say, "Oh, I've got your property."
Me. Yeah.
I mean, that's not the way this works. You have to buy them at the tax sale. Anybody who comes and pays taxes, and unfortunately we have people that don't understand the process. They come in and they pay, their next door neighbor's taxes because they know that they're either not around or they know they didn't pay them.
Yeah.
You've just done them a favor.
Right.
Because you've literally paid their taxes on their behalf. When I get taxes and when I get payments, it doesn't matter who it comes from.
You're saying prior to the auction, just if someone was like, they think, I'm going to.
Yeah.
I can show that I paid this for this and it's now mine.
Oh, so that happens.
Or even the years after. They know that, I know they got their taxes sold last year, so this year I'm going to jump in and pay them. That doesn't work. I mean, you can't do that. You have literally just done that person a favor by giving them your money.
Yeah, and you're not going to give them back.
I'm not giving it back unless they pay extra, and I can show that you deserve a refund.
Right,
but otherwise,
but only that amount.
They can walk in and say, "I want to pay my bill," and we look at it and say, "It's already been paid." And they're like, "Oh, thank you."
Yeah.
Who paid it? Well, I may know and I may not, depending upon what they. Yeah. Little angel investor did that for you. Yes.
Yep. They're really mad right now. Yeah. So how many houses or I guess properties would you say go up for auction every year?
There are quite a few.
Yeah, anywhere from
what's your average?
1,200 to 1,600.
Oh my gosh!
And
then
in
how
Williamson
many people,
County.
In Williamson County, yes.
How many people show up to the auctions? Would you say then?
Usually between 20 and 30 buyers.
That's it.
Yeah.
And where is this held?
It's held at the.
And what time?
It's held at the county administration building. It starts at 9:00. We usually run until 12:30 or 1. To run through all those properties. Again, not all 1,200 are bought or 1,600 are bought. Surprisingly, Williamson County has a high delinquency amount that go to tax sale. For example, McLean County, which is where Bloomington is, they have like under 700 or 800. Okay. And McLean County is, Bloomington normal is, 100,000+ people. Right. They have much larger, population, many more properties, but it just varies. But I send anywhere from 4,000 to 6,000 certified delinquent notices every year for people that have not paid either one or both installments.
Can you find these properties before the auction?
Before the auction?
Like, is there just a list out there on your Facebook page or something? Or do we have to?
She's got Zillow for delinquency.
So here's how this works. I send out those certified notices.
Okay.
Then I'm required to publish all of the delinquent amounts or the delinquent people or properties in the newspaper.
Okay.
So I need
Prior
to
to
check
the
out the
tax sale.
newspaper.
Good old newspaper.
So yeah, I mean, you have to use a local newspaper. So it's either, your only option is the Star, the Marion Republican, or the Southern Illinois. And everything is going to be listed. So every property and every township, throughout the county that hasn't, made their payments are all listed in that. I'm required to do that, I think, 15 days prior to the sale when it happens. If you're a tax buyer, we actually generate a list. They buy the list, and every week or we update the list for people that have come in and paid, properties that have dropped off. Because again, this is a business. They have, you can watch and see their color coded Excel spreadsheets of, there's priority, maybes, stay away. They have this down to a science of what they want to do. So, that's the list can be bought, and yeah, but you can drive around, you can use Zillow, you can do whatever you want to look, at those properties and see, what's there. And you'd be surprised. It's not the, what you would consider to be the rundown or the properties nobody wants.
Really?
I mean, we have, commercial properties, hotels, restaurants, commercial buildings. We have homes that are, several $100,000, in value that are sold at the tax sale every year.
I'm getting a new side hustle, Ashley.
Yeah.
I for sure am. I've figured it out.
So interesting.
Yeah.
Well, I wanted to ask you, since we're kind of getting to the end of this episode, do you have any tips for people to stay consistent and stay ahead of paying their property taxes, budgeting, that kind of thing, to plan for the next year?
Yeah, I do. I mean, one, you need to familiarize yourself with your bill. I mean, as you guys mentioned, you may or may not have all the exemptions. I mean, the goal is, and I mean, nobody likes to pay taxes. I don't like to pay taxes. And when I have people that come in, I mean, we try to do everything we can when we see the bill to see if there's any way to save them money. So familiarize yourself with your bill. Don't be afraid to ask, do you qualify for this exemption? You may not, and it may be something you may not qualify for this year, but you might qualify for down the road. I mean, again, you have to turn 65 to be able to get that homestead exemption. Calendar that. Make sure that when you turn 65, you can bring in your driver's license and show and sign up for that. The senior freeze, for example, there's an income requirement, but you may not qualify for it now, but you may have a change in your lifestyle or whatever that may, allow you to qualify for that. That will freeze the assessed value of the property. It's not going to freeze the taxes themselves, but it'll greatly reduce the increments that they do increase. So those are things that you need to do. I mean, if you don't have the discipline to be able to put money back, I mean, I would set up a separate savings account, and put back money for your taxes. If you don't have that discipline, if you have a mortgage, I mean, perhaps look at, setting up an escrow account. I mean, for me, I've always been disciplined enough to be able to put money back, but a lot of people, can't and don't. So, again, use those tools that are available. Do like you mentioned, or I mentioned the prepayments. If you get that bonus, if you work overtime, if you inherit money from, a relative you didn't even realize you had, and a check shows up.
What a dream.
Yeah. But perhaps take some of that money and apply it, to your taxes. So then you're not worried about it. And the other thing is, I mean, taxes are always due. I mean, I have a lot of people will call and be like, they're not out, in June or July. I don't have the money. I'm like, because they're too much late. You still need to pick a date that you think they're going to be due. I mean, like I said, the statute says June 1st and September 1st. So assume that your taxes are always going to be June and September. So start putting your money back to be able to have at least that first installment, there by June 1st. Right. And then that way it doesn't matter if the taxes come out and you have a due date in July or August, or unfortunately, this year, September and November, you still have the money put back. And that's the thing that people just have to, don't get caught up in the due dates per se. I mean, get caught up in being able to identify what works in your budgeting schedule and then work off of that. And then when you have the money, put it aside, make sure you don't pull it out, or I've got, extra 2 months here before and start pulling it out. Identify it, make sure that that's what it's going to be used for, and only use it for that.
Yeah, that's so true. We, have this account that we put aside and we actually hide it from ourselves. So we make monthly payments to that. It's called our tax hold account. And then we don't see it. We forget it's there. And then at the end of the year, we're just like, we look at that account and there is the money, thankfully. Yeah. But it's helped us for sure.
Well, and I mean, being in banking too, like you can have like an automatic
auto pay
withdrawal from whatever account. We have a lot of people that have direct deposit, at the county, that a portion of their money goes into various accounts.
Right.
I mean, identify what, put whatever amount you need to from your direct deposit. You'll never even see it when you're getting your check that, that week or every 2 weeks or bi-month or whatever it may be. I mean, you're working off of that as your amount to budget and use for your monthly bills. That other money's already been put back and it's there. And then boom, 10, 12 months later, you've got enough put back. When you see that bill and you're shocked by the amount, you're like, oh, it's not so bad because I've already got that money put back.
That's a good tip.
Okay, final question.
Yes.
If someone's super frustrated and they feel like they've been overassessed, how do they go about disputing their taxes? Who do they go to?
So they would fill out what's called a border review form. In essence, that's with the assessor's office. You fill out the form. You go before what's called a border review, which is a panel of individuals that have certain credentials that will review your information that you're providing to them. So you fill out the form. You need to use Zillow or a realtor or whomever to get values of properties, and then say, okay, these similar properties are valued at X, and then my property is valued at Y. It's much higher. It should be reduced. That's how you go about doing it. You have to have information. You have to have tangible information. You can't say, I just don't like the fact that you increased it. And my neighbor, did. And the other part too is, don't just look at a neighbor's bill.
Right.
Because you may have the owner occupied exemption. Jill doesn't have it. So your bill's $400 less, even though you live in the same exact house. Well, Jill could also have a $400, reduction in hers if she had the right exemption. So we have a lot of people like my neighbor, and like, you look at their bill and they say, well, they have an over 65 exemption. They have a senior freeze. They're
veteran.
They're a veteran. Yeah. Their house hasn't increased in 15 years because they've been eligible for these exemptions.
Right, yeah.
So you have to make sure that you're comparing apples to apples. Otherwise you're just spinning your wheels. If you're not happy with the determination of the board review, there's another step you can do, which is a PTAB, which is the Property Tax Appeal Board. That's through the state. You actually say, I don't agree with what they did. I want the state to make the determination. Each side presents their case just like a lawsuit or a legal proceeding. And then the PTAB board makes the determination of who was right. And then if they say, well, Ashley, you were right, we're going to lower it. You. Not me. I don't assign value.
You.
I do not assign values, remember? So, but they'll say you were right. So then we have to make the adjustment. We'll, refund the money, to you through that decision. We get those decisions. And then I'm trying to remember, I think it's capped up until that next quadrennial assessment. Like it's frozen because this is what the value the state says it is worth.
Sorry, go ahead.
Well, I was going to say, most of the time we see this happen with commercial buildings. Very rarely do you see it happen with residential because there's so much activity residential wise that there's enough state, information that it shows here's the value for this area. Here's what we're coming up with. And then the state also, there's with the assessor that he can equalize factors or equalize areas, or the state can add what's called a multiplier saying, well, you don't have your county assessed properly. We're going to increase it by a flat amount. So the state already kind of has a hand in that per se. So, and most of that happens with those, residential, type properties, because you're back to usually the income or the cost approach on the commercial because there's not nearly as much, activity and turnover and action for those things.
No, I was going to say, Has there ever been the opposite? You know, someone goes to dispute it and they find out, oh, their property's worth a lot more actually. And then next year it's going to.
I mean, I don't know if they've ever increased it. I mean, right then, but it can have a reverse effect.
Yeah.
You know, you might be, it could be something where there's a building or something that has been added, you've added on, or you finished, but they're not chasing you. They're not, it's not like you got a target board set up like, oh, well, the three of you came in, so we're going out there for the next 2 years.
It does.
You know, we're like, oh, we're honing in on that one. But I mean, it can, have somewhat of a reverse effect. What someone has to ask themselves is, even if you lived in your house for 20 years, what would you sell your house for? And then look and see what the fair market value is on the tax bill. I mean, if I'm going to say my house is worth $200,000, I wanted to, put a for sale sign on it, sell it. I would take that offer. That's my hope and dream, but I would take that offer, all day long. And my fair market value on my bill is $150,000. I mean, even though the assessed value went up and my bill went up, you're still technically underassessed or undervalued for what you would be what you're being taxed for what you would truly sell it for. So that's the part where you got to weigh it. I mean, nobody likes to pay taxes. Nobody even likes to pay their fair share of taxes. But you do have to ask yourself, if I can get more, should I just be happy with where I'm at, or do I want to push the envelope?
Last question from me. I'm sorry. I know you had the last question, but
sure I'll have
one more
another
that
one.
came up. So we talked a lot about exemptions. If you didn't, so the tax bill already came out and I realized that I had an exemption. I didn't apply for it in time before the tax bill. Can I go and
Yes.
have it?
Yeah.
You can.
You can. So what happens, obviously, whatever exemption you're eligible for, like for this year, has to have happened in the 2023 calendar year, because you're paying 23 payable 24. But I could send your bill out. So here, this is what you need to do.
Yeah.
So
this is step by step. Jill, do
listen
this.
To this.
Yes.
You need to go in, bring your driver's license with your, address. You go in and you go to the assessor's office. You fill out, your owner occupied exemption form. As long as you qualify for it, they then prepare what's called a COE, or a certificate of error, which means that there was something missing from the bill whenever we created it and sent it out. They send down the COE to us, and then so we type in all the information, and then we correct the bill. So in your instance, you can come in if you qualify for it. I always have to, preface, you have to qualify for it.
Yes.
I don't know the answer to that, so I can't guarantee you, but if you qualify for it, you can get that COE done. We will do a corrected bill, and then you will pay that new amount. Even if you've already paid the first installment, we can still do that corrected bill, and then we can, it will reduce the second installment amount. And even if you paid the bill in full and you did the correction and there's an overpayment, then you can ask for the refund. So you have the option, yes, to apply for it now if you are eligible for any of those exemptions: owner occupied, the over 65, disabled homeowner, disabled veteran, home improvement exemption, any of those. You have the ability to sign up for those. And then, yes, you can do that certificate of error, as long as I don't have and actually you can do those all the way up until January 22nd this year, the day before the tax sale. Once, those can be, they have to be able to do them, and I have to get them in my office to be able to, to do them. And usually we tell people it takes 2 to 3 weeks, because the assessor's office does them.
Right.
The board of review signs off on that certificate of error. Then it comes to my office for us to correct the bill. So there is a procedure and a process that's involved, and it's not just you coming in. There could be several. I mean, we have stacks like on a cabinet.
I can't even imagine.
That are this tall. That in each turnstile that we have to adjust and correct every year. And it goes both ways. I mean, there are other ones where they've, picked up something, or they realize that they weren't allowed to have an exemption. You do the certificate of error and you increase the taxes. Because again, it's to be fair and equitable. If you're deserving of the exemption, you get it. But if you aren't deserving of the exemption, you shouldn't have it.
Right.
if you're 64, you're not getting that 65 plus.
No. And if you're
Well,
25
and I think there's
you bought
actually
a
an
house,
income limit on that one too. Like you can't make a certain amount of money.
That's the senior. That's the
senior.
freeze. That's the freeze.
freeze.
Anybody from, I mean, you can be a billionaire and still qualify for the
senior.
over 65,
The over 65
exemption.
one.
Yeah. Yeah.
Well,
but,
okay.
Yeah. But you can't, if you were a 20-year-old and you bought a house from somebody that had all those over 65 exemptions, and then
you can't pass
reverse
it.
it.
you accidentally
come with the house.
got it for a couple of years because it was just missed.
Ooh.
They can take those off, and it's you weren't allowed to have it to begin with, so
You're not 65.
No.
That's great.
So good.
This has been so good. Thank you
Yes.
so much. I feel enlightened about taxes in our area and what you do. So thank you so much for being on with us today.
I'm glad you had me.
We really appreciate it. I know
the
this is your busy
opportunity to
season.
Explain it as best I could.
You did a great job.
You did a great
I
job.
understood it. So
Well, that's good.
That's great.
That's good.
Thanks again, Ashley.
Thank you very much.
Thank you all for listening, and we'll see you next week. So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.